class before official spring on a beautiful day. It's amazing how fast this semester has gone, and when I've gone back and I've looked at all of the seminars or lectures we've had here and all the PowerPoints that we have up and the guests we've had and what an array of guests they've been, I'm just amazed at what we've been able to cover. And of course, every week we get more news about the economy, and over again, when I watch the news, I hope you're finding the same thing, I'll hear something on the news about something the Treasury's done, something the Fed has done, or something, for that matter, the French have done, and I think, oh my God, we heard about that 6 weeks ago. Well, tonight we have a really special pleasure because I have with us three of not only my favorite academics in the whole world, but three dear friends. One of the things that is not discussed as much in the literature, particularly in economics, or even in some cases in sociology, in many cases in political science, something which has not really gotten much attention today, although it would have been in the news if we were doing this 30 years ago, is the whole question of labor market policies and the role of trade unions. If you go back to the mid-1950s, about 36% of American workers were members of trade unions. And by my rough back-of-the-envelope calculations, probably another third of the American workforce weren't members of unions, but got many of the benefits that unions had won in terms of wage increases, in terms of pensions and health insurance benefits. In some cases, simply because a firm wanted to try and prevent their members from joining a union and gave them these increases. But as I think I mentioned in an earlier session, at least my stars tell me that the growth of the trade union movement in the post-World War era had a lot to do with the construction of the first real middle class, and that it helped drive the economic growth that we saw from at least the end of World War II to the mid-1970s. At that time, particularly as someone growing up in Detroit, Michigan, where one of the most powerful unions was located, the United Automobile Workers Union, with 1.5 million members back then. There were roughly 450,000 members in the UAW today. The UAW was a major force, not only in the city of Detroit, not only in the other cities where auto was powerful, Flint, Michigan, Pontiac, Michigan, throughout Ohio, parts of Pennsylvania, the rest of the Midwest. It was powerful nationally. Its president at the time, a fellow named Walter Reuther, one of my great heroes, could easily pick up the phone anytime he wanted and contact President Johnson or President Kennedy. Senator Robert Kennedy was a dear friend. There was a tremendous amount of power, and it was also a very progressive force for social change, not only in the industry, but helped lead the civil rights movement, actually was deeply involved in the early environmental movement, actually involved in the feminist movement. And of course, it worked with the farm workers and others. It fought for minimum wages, even though every single one of its members was paid better than that. It was a great social force. Today, union density is in the neighborhood of 11 or 12%, maybe a little bit higher than that, and only higher because of the growth in public sector unions since 1960s and the executive order that President Kennedy signed in 1961. Because so few, 1 in 7, 1 in 8 members of the workforce are members of unions, unions obviously have less clout economically, but also a lot less influence politically, even though they help often to get Democrats elected and in some cases liberal Republicans. Nonetheless, unions remain an important force in America, and all of the labor market policies that began during the New Deal with the passage of the National Labor Relations Act in 1935 and onward certainly have played a role in how we've constructed our economy and how our economy operates. Today, of course, there's lots of criticism of unions. I noted 3 stories in one issue of the Boston Globe, the liberal newspaper, castigating the public sector unions here in terms of the transportation unions in one, the teachers union in another, and construction, I think, in a third. Tonight, we're going to take a real good look at the role of trade unions and labor market policies how they contribute to economic growth or affect economic growth, and what they mean in terms of opportunity. And with us, starting first with Lisa Lynch, who is now the Dean of the Heller School of Social Policy and Management at Brandeis, and also chairs the board of the Federal Reserve Bank, will be leading off. Following Lisa will be Tom Kochan, who's professor of management at the Sloan School at MIT, and in my opinion today, the Dean of Labor Management Relations in the whole country. And then finally, our own Steve Vallas, chairman of the Sociology department here at Northeastern, and the newest member of our university community here, having come here last fall. So without further ado, Lisa Lynch.
Good evening, everyone. It's a great thrill to be here and have an opportunity to talk with you about these issues this evening. And I appreciate the opportunity to get out of the office and not be a dean for a moment and talk a little bit about trade unions and labor market policies, especially at a point in time where our discourse seems to focus mainly on bailouts of banks and insurance companies, and we don't really hear a lot of these other discussions going on at the same time. I'm just trying to figure out how I can manipulate this. So for the okay, great. All right. So before we go into a discussion on the role of trade unions and labor market policies affecting economic growth and opportunity, I want to first set the stage for the challenges ahead with respect to both the labor movement and more broadly labor policy in the United States. And these are numbers that I fear too many of you may be too familiar with, but let me just go through what's happening in terms of the labor market and what can be done to address some of these issues. So we recently got an update, we get this every month, on the state of the labor market in the United States, and it was reported for February 2009 that the unemployment rate had shot up to 8.1%. What does that 8.1% mean? Well, that's 12.5 million people who report that they're out of work. Now, you only report that you're only officially counted that you're out of work if you have looked for work over the last 30 days and are available for work. And one of the problems is that as people spend more and more time out of work, they stop looking for work. And you might imagine, especially in this housing downturn, where your major asset is your house that you can't sell, and you can't move, that after a while you may stop looking, especially if you've been out of work for a long period of time. So another number embedded in that report that we got for February was that the share of long-term unemployed, those are people who've been out of work for 6 months or more, is up to almost 1 in 4 people. So we've had a sharp increase in the unemployed. We have a sharp increase in the number of people who are locked in long spells of unemployed. Typically when we get into that, we then see a melt as people give up looking. But there's other sources of underemployment that are reported in the monthly jobs report. There's a question in the survey that asks people, are you working part-time for economic reasons, either because your employer cut your hours or you could only find a part-time job? That number is up to 8.6 million people that say they're working part-time for economic reasons. And about 95% of that is due to employers cutting hours. Now, they get counted as employed. They're not counted as unemployed. But these are folks that are trying to meet those mortgage payments for that house that's underwater, meet their other bill payments, and now they're not taking home in terms of weekly wages as much as they once had. We have these discouraged workers, folks that have just given up, about 731,000. So you could recalculate the unemployment rate, and I encourage you, when you hear the monthly statistics, to look for what this rate is. It's reported by the Bureau of Labor Statistics, what we call an underemployment rate, that adds in those people who are officially unemployed, those people who are working shorter hours because their employers have cut back their hours of work, and those people who've stopped working, they're ready to go back to work, but they know there's just nothing available for them. Barry talked about some of the places, Flint, Michigan, you know whether or not there are jobs available for you in Flint, Michigan or not, and the answer is no. So the underemployment rate in the United States is close to 15% right now. This recession, some people have talked about it. Is it a recession? Is it a depression? There's all these bad jokes. It's a recession when somebody else is laid off. It's a depression when you're laid off. Economists can talk about, well, how much do you need to have GDP drop to make a difference between a recession and depression? But one thing I think we can agree on is that this is a dramatically different type of contraction of the economy, especially with respect to the labor market, than what we've seen in the previous two recessions, one that started in July of 1990 and the second one that started in March of 2001. So if you look at these three lines, this looks at the monthly change in employment since the start of the recession. So it starts at the beginning of the recession, then tracks out what happened. So typically, recessions last about 12 months. And that's why some people are saying, well, this looks more like a depression because it started in December 2007 and it's still going on. But not only is it still going on, if you look at that yellow line, we're well into this recession and it's getting uglier. It's not getting better. So the job loss has been accelerating as we've spent more and more time in this contraction of the economy, whereas in previous recessions we had job loss going along, sort of peaking around 7 or 8 months into the downturn, but then tapering off as we go further along into recession. So that's a very different type of picture than recent memory. Actually looks similar to what we had in the early 80s in the United States. Unfortunately, there's been a lot of records that have been broken with this recession with respect to the labor market, and they're not the kinds of records that you like to break. So we have an unemployment rate now that's the highest in 25 years. We've had the largest 4-month decline in employment since September 1945. That's not a typo. Manufacturing employment is to the lowest level since 1946. This is a sector that has historically had higher rates of unionization. We're at employment levels that are at the lowest since 1946. In construction, 40% of job losses have happened in the last 4 months. And this is an industry that has been contracting since January of 2007. And in fact, this industry has now lost all of the jobs that it gained during the housing boom of 2003 to 2006. So all of those gains that happened in construction are gone, and they're going to continue to contract going forward. We have the average work week now at the lowest number of hours since 1964, and the reason why it's 1964 is that we didn't collect the data before 1964. So that's as far back as the series goes. So a lot of people out of work, and for those that are in work, working a lot fewer hours than they were before. Let me just give you a little highlight on some of the demographics of who's out of work, because this enters into some of the discussion about labor market policies. Let me first look at education. So if you look at unemployment rates by educational categories, broad educational categories, less than high school graduates, people with some college, and those with college, you see that those with less education have much higher unemployment rates than those with more education. But you see across all of these educational categories, and this is maybe unfortunately one area where equality has applied, across all of these areas there's been a dramatic increase in the unemployment rates by education. No one is immune in this recession to the contraction that's going on in this economy. Again, that's different from past recessions where we've seen particular sectors particularly hard hit, but other sectors growing. And I'll come back to this. There is one sector that is still growing in the United States, and that might be one of particular interest here in Massachusetts. But all of these educational categories, everyone has seen a dramatic increase in their unemployment rate. But it is still true for those of you that are in college, that it's better to have a college degree than not in terms of your unemployment rate. So don't drop out. Finish. Speaking as a dean. If you look by race, ethnic background, you see that Black or African Americans have much higher unemployment rates. Their unemployment rates have increased. Hispanics' unemployment rate have increased as well and whites too. What's interesting here that some folks have focused in on a little bit, for Hispanics, there has been a very sharp increase in their unemployment faster than for whites and for blacks or African Americans. And in particular, if you look at another measure of labor market activity, that's the number of people that are employed in a category, in a, you pick your age or educational category relative to population. If you look at the fraction of the Hispanic population that's employed, historically that's always been the highest employment to population ratio. I'll just give you some numbers. So a year ago, the employment to population ratio for Hispanics was 64.3%. It's down now to 60.6%, and that's less than whites' employment to population rate. And that's the first time that's happened for Hispanics. And there's a lot of discussion that people have raised with respect to the contraction, in particular in the construction industries and some of the other sectors that have been disproportionately hit, where a lot of more recent immigrants were disproportionately employed in. And that this, because this is a recession that was triggered by housing crisis, that group in particular has been disproportionately affected. And then there are teens. So we have, 1 in 5 16 to 19-year-olds who's looking for employment cannot find a job. And obviously, when you think about what's going to happen this summer in this city, that gives you real pause for what these kids are going to be doing. You can also slice and dice these data slightly differently and look by industry and see which industries have been experiencing the greatest numbers of job loss. Certainly when you read the newspaper, you would think that all the job loss is concentrated on Wall Street. You see all the stories about all the job loss in financial services. But I think it's important to remember that actually the sectors that are taking the biggest hits in terms of both sheer numbers of jobs lost and percentage change in job loss are construction and manufacturing. Typically sectors with skilled labor, opportunities to earn solid, good wages, middle class opportunities in those sectors, and they have taken significant hits in this recession. Certainly financial services has contracted as well as business and professional services and the retail sector. And one bright spot, month after month, in terms of industries has been education and healthcare, and in particular the healthcare sector that has been growing in employment opportunities. Education sector is probably going to get flat or contracting as states end up having to lay off some teachers in spite of the stimulus bill as they're forced to balance their budgets. One of the things, and maybe Steve will say something about this, as a labor economist, that has struck me about this recession compared to past recessions is how individual employees have been responding to this significant contraction, in particular the acceleration of the contraction in the labor market. And I call this sort of phenomenon of pain sharing versus gain sharing. You see a lot of stories of employees that are saying, I'm willing to give up hours of work to keep jobs at my business. I'm willing to give up my 401k benefits, the employer match on my benefits in order to keep jobs at my establishment. I'm willing to take a furlough or take a cut in pay in order to keep my job and others in my business. So you see this altruistic streak, which I actually think is a character of the American workforce, but of groups of employees, some of them unionized, a lot of them not unionized, but banding together to support one another. Okay? Unfortunately, you also see the gain sharing side. Some people that have no shame whatsoever to continue to take significant and large bonuses in spite of significant failures and contractions in their industry. So you do see an inequality in reaction to the job losses, and it does seem to be concentrated where you see lower wage workers willing to step forward and do something not just for themselves but for their fellow workers, and those that are the most highly compensated having no problems to continue on that front. Okay. So that's the gory news. Now let's start talking about the positive things that are happening. And I'm actually one of the economists that's not in the camp that we're in a depression. I think we're in a significant recession and contraction. But there's a lot going on that's going to make this recession not look like the depression that we had in the 1930s. We've got, and I know in this course you've talked about monetary policy and all of the stimulus that's been coming on that front. And today we got some more news from the Federal Reserve and more actions that they're taking to stimulate the economy. And we had a significant passage of stimulus bill. Close to $800 billion in stimulus, that as well will have a significant impact on the economy. Now tonight's focus is on trade unions and labor policy that will provide economic opportunity. The stimulus bill, everybody sort of thinks of it as sort of quick one-time stimulus into the economy, but embedded into the bill are what I would call some of the foundations for policy reform going forward that are going to be critical to address not only sort of the one-time or hopefully short-term crisis that we're facing right now, but to set the stage for more balanced growth and opportunity, especially for those workers in the middle class. So the first component of labor policy reform that's embedded in the stimulus bill has to do with unemployment insurance. Now, in the bill, there was appropriately money set aside to increase the weekly benefit by $25. There was money that was set aside to extend benefits for a longer period of time. You have 1 in 4 workers that are out of work for 6 months, so so you need to extend unemployment benefits. But there were also incentives to states to embrace the Unemployment Insurance Modernization Act and extend unemployment benefits to more workers. Only about 37% of those people who are out of work receive any type of unemployment benefit in this country. And when I talk to audiences such as this in Europe, and I say that, they look at me like I'm a Martian, because that is just unheard of in European context. So only about 37% of people that are out of work are actually collecting any benefits. Now, some low-wage workers are ineligible for benefits because they have accumulated insufficient past earnings. And the irony of this is, you're in a crappy job, you can only work a few hours, you get paid very little, then you can't meet the income thresholds to actually be eligible for unemployment benefits. When you lose that crappy job, it doesn't pay you very much money. So in the bill, there's $7 billion in incentive payments to states to establish an alternative base period that would capture more low-wage workers and give them income support while they're out of work. There's also incentives to close the gap between the number of people who are unemployed and the number of people who receive unemployment benefits by giving benefits to 2 out of the following 4 types of workers: part-time workers who are denied state benefits because they're required to seek full-time work. Remember, I told you, in the numbers, we see that a lot of people are reporting that they're working part-time because their employers cut their hours or they can only find part-time work. So imagine, you're out of work, you lose your benefits, the only job you can find is a part-time work. You know that, and you've made other arrangements for yourself, but the state says, well, we're not going to extend your benefits because you're only seeking part-time work. We need you to seek full-time work. For individuals who leave work for compelling family reasons, including domestic violence, in most states you would be denied unemployment benefits if that's the reason why you left work. So be more flexible on that front. For workers with dependent family members who qualify for state benefits, but whose benefits need to be increased to help care for their dependents, a lot of working women in that category, or for permanently laid off workers who require extra unemployment benefits to participate in training. Too often they're denied unemployment benefits. So there's some incentives in this stimulus package for states to re-examine their unemployment insurance system and provide more economic security for people that have been displaced. So that's terrific. A lot of us have been pushing for that reform for 20 years, and it's about time. Another area where we've seen significant labor market policy reform in the stimulus bill has to do with job training. Significant increases in formula-based job training on the order of close to $3 billion to fund the Workforce Investment Act. And that's terrific news, especially because when we look what's happened over the last 15 years, the United States has really pulled away from federal assistance for workforce training. In 1985, the U.S. government spent a little over $30 per worker on government training. By 2004, that was down to $17 per worker, adjusting for inflation. And at 2006, at the peak of the expansion, if you looked at how much was being spent on training, we were spending about $1 billion less than what we needed to keep up with where we were in 1985, which was still way too low compared to where we need to be for a skills-based economy. So seeing another $3 billion put into the game with respect to job training is terrific. There's $50 million in addition for youth bill. One of the areas, though, that again is quite creative and innovative in the bill is that there's an incentive grant for states to apply to for up to $750 million worth of training in high growth areas, green jobs in the healthcare sector. And I can assure you that here in the state of Massachusetts, I sit on the Governor's Council of Economic Advisors under the wise leadership of Kathy Minahan. And certainly here in the state, you can be sure the state will be applying for that training money. This is a different way of thinking about training investments. Historically, we've thought about training for displaced workers, disadvantaged workers, and youth, and it's a very reactive model. We wait for them to come into the door to provide training. In this bill, we're actually giving an incentive for states to set up training in high-growth sectors, in sectors where we think there's going to be job shortages. That gets the states then out to look and create programs and bring people into those programs. It's a change in the approach towards job training, which is good. And they set aside an additional $200 million for dislocated worker assistance, a national reserve. Because too often what happens is that we have kind of these peaks and troughs in government training money. So 1 year we get a lot, the next year we don't. We don't have a reserve pool that we can tap into. They're building up a reserve pool of money for dislocated workers so that even when the formulas would tell you didn't have to have as much money set aside for training, you'll have more money set aside for training. So now let me just finish up highlighting, we've done the stimulus bill, probably do a second one if you want to forecast for me sometime next year. We have a new Secretary of Labor. What are some of the things that she should be working on? And I'm going to set the stage, and then Tom is going to follow through in more detail on this. First one has to do with trade union recognition. This is something, in my own work, I've spent a lot of time analyzing the impact of trade unions, both on workers' wages and on productivity inside of firms. And we know empirically that there's a lot of benefits to trade unions. Workers who are members of trade unions have higher wages and higher benefits. A lot of the work I've done is looked at the amount of training that workers get from their employers as opposed to the government sector, because they're not getting it from the government sector. We see workers that are in unionized firms get much more skills-based training than workers, similar types of workers in non-unionized establishments. We see higher productivity in unionized establishments that have embraced high-performance work practices, higher even than non-unionized establishments that have done that. And that's, I think intuitively you can wrap your head around that when you have labor and management sitting down and doing problem solving to come up with good solutions that are permanent and make a difference. And we see much higher productivity, and we get on that sort of win-win path, higher wages and higher productivity. And we see much less inequality within firms and across businesses when we have higher rates of unions. So trade union recognition may seem like, well, why would we be pushing that right now in the middle of the recession? That's not going to make businesses competitive. I'm here to tell you that those businesses that have worked with their labor movement and worked with innovative workplace practices are more competitive. So the time to be embracing that is especially right now in a recession. Other things that the Labor Secretary needs to do. We have a training and employment system that is focused on, at the government level, of funding training programs for workers who are disadvantaged or workers who have been dislocated from employment. But we don't really have, I would say in general in our labor market policy, we've not really recognized the fact that we're an aging workforce, we're an aging population. And systems that worked well in the 1970s when we were a relatively young workforce in terms of accessibility, timing of programs, et cetera, don't work as well for a workforce that the median worker is now in their 40s as opposed to in their 20s. And I think that this is going to challenge the current labor secretary to think about how to reform the Employment and Training Administration to provide more assistance on employment and training for an aging workforce. Well, workers are going to need training at a later stage in their lives when employers may not be willing to train them and when they may very well be moving into new sectors or encore careers. We think of retraining in a much narrower way, and that will be one challenge. The second challenge will be the role of wage insurance versus training. I think in the past people have assumed that as we went into a recession, older workers, and by older workers, and it gets very uncomfortable as I say this, people over the age of 55 and above, because that number is getting closer and closer with every year, but older workers, it would be better just to give them some wage insurance or put them on early retirement and kind of send them out to pasture and they'll go away and that will be that. Well, when we look at this recession, actually in the last recession as well, the category where we see the labor force participation rate going up is those over the age of 55. And all of you over the age of 55 probably know why. After the age of 55, you still have your mind, you still have your body, you still have capacity, you have much greater health expectancy in the past, but your pension, you don't even open those pension statements, the 401k statements, because that's just misery. Your company's probably dropped the defined benefit plan. Social Security is not going to be enough for you, and you're not eligible for health care yet. So you have to work. You have to continue to work. So providing wage insurance for a year or two for people in that category is a way of responding to recession. Just doesn't do it. So you have to think about reinvesting in older workers. But our Employment and Training Administration is not really in that mindset. That's going to require a change. Certainly, in the midst of this crisis, if we've learned anything, we've learned about the importance of financial literacy. Actually, when I say workforce, it might actually include some of the people in financial services, which seem to have been a little illiterate on some of the things that they were doing. But again, I think the Secretary of Labor, Department of Labor, can play a very important role with respect to financial literacy of the workforce, especially with respect to understanding the nature of pension benefits that they're getting from their employer, defined contribution plans, etc. We've had a complete deterioration of enforcement of wage and hour protection in OSHA over the last 8 years, and it's time for that to be fixed. And that's certainly something that I anticipate that the Secretary will be focused on. And then finally, work-life balance, family leave, it doesn't go away. It's still a problem, it's still a challenge. And now we're in a generation with an aging population where we're a sandwich generation. We're taking care of our kids and we're taking care of our parents. And the challenges with respect to getting time off from your employers and getting assistance to meet those family obligations are going to be different than they were in the past when people were thinking primarily in the context of childcare. So, lots of work to be done, lots of good things to happen, and now Tom will pick up from here and go into more detail. Thank you.